Good afternoon, guys. Today is October 29th, Thursday. We're going to take a look at the SPY, the QQQ, IWM, and XLF. Okay, let's get straight into it here. Right now, we're kind of in a weird place for the markets. Let's take a recap on what we were discussing last time we had a video. What we were calling this was the last two videos, we were calling this a bull flag pattern. And then we decided it pulled back far enough to where we could then call it just a regular channel. And that's kind of what we're looking at. It was a channel. And since we've broken down out of the channel, it's more bearish than it is bullish. And if we actually did a measured move on this, let me zoom in here, really get it up here. So if we did a measured move on this, let's say we were calling this some sort of a channel bull flag scenario, and as long as it stayed inside the flag, we were kind of okay. The problem is we were expecting it to break out earlier. I think this was a Friday of the previous week. I don't know. I think there's a few things we could take a look at and see, or maybe the Friday was back here. It broke down bearish, not bullish. And so what we could do is we could take this measured move, and let's say this was the flagpole, and because it didn't break out to the upside, we could do a measured move and say it broke down to the downside. Now, since then, this is where we have to really urge caution. We have to be careful in our trading. We have to start trading, especially in these volatile times. We have to lighten our position sizing just a little bit, or possibly even a lot, depending on how much you're currently doing. You're going to start to see these swings. They're going to be coming in to the low side a little bit wider, to the upside a little bit wider. They're going to start, the volatility in the options, as you can see down here, is going to start picking up. It's pulling back a little bit today, but you'll see it start to pick up here, the implied volatility. This is where you really have to be careful with trading options, and it's also why we trade smaller position sizing. Plus, we have elections coming up in a couple days. Do we really want to short every rally that we get, or buy every dip that we get? That's really trader's choice. Right now, I can see the market closed at $329.98. After hours, it looks like we had earnings coming out. Several names: Google, Facebook, Amazon, Apple, big names. Right now, we have to kind of let the price settle. So right now, we're down a little bit, 328.90. So we're down about $1. So this price action, just first thing is first, what we're looking at is it did come into some support here, which is why there were buyers that showed up at this price level. There is also support down around here. I don't have it on the screen, but I'll give you an actual price of this in case we get down that low. The price of this is around 321.50. Below that, we have a little bit of support around 319. I'm not sure, though, that I would count on that holding if we did get down there in the next day or two. I'm not sure that would hold. So we have to be very careful with these trades. So as far as the price action yesterday into today, this is pretty significant on way higher than normal volume. We have to really look at that and ask ourselves, were these institutions selling these positions? Were they possibly option hedges that they were letting go of? Or were they just selling their accounts because they want to get out from under this thing before lower prices? One thing I'll note here is that this is bearish. This candle that we had yesterday, well, obviously it was bearish. I don't need to tell you that. But today's price action, looking intraday, if we go to the intraday time frames, there is a part of it that looks bullish, but then looking at the daily chart, this looks like it could be possibly another bear flag playing out. So if we have another day, let's say tomorrow, closing inside this, and then another one inside this, instead of trying to trade outside of the flag itself, and I'm not sure if I said a bull flag, maybe I said a bear flag, what I mean is a bear flag, what we want to look for is it to break this price level before we attack it to the downside. And then again, wait for it to break out before we attack it to the upside. Also, if you're trading options, again, very expensive. I'm not sure that it's worth it. We do need to have a little bit of a discussion, because it looks like dip buyers, some sort of buyer showed up this morning, or short covering showed up this morning. Today was a little bit heavier volume, and I don't know if that was just shares traded across the board, or if there was more selling or more buying. Let's go into the news. There's something I want to kind of point out for you guys, and I'm not sure if I can get it up on the screen. Let's do this. I'm going to scroll down to, for one of the first things I saw this morning that I wanted to look at was possibly understand why the market did what it did. And I actually got a notification, and it was at 5:32 a.m. USA GDP quarter over quarter for Q3 33. 33.1% versus 31%. And so we can see already that the estimated prior, or the prior was 31.4%. So something we can look at, and I'm going to just do this so you guys can actually see what I'm reading here. Right here, we see USA GDP Q over Q for Q3, 33%. So this is kind of something I want to dive into a little bit, because some people will say, well, what we'll see in the news is that the market reacted today. The market was bullish because of the GDP numbers. I just want to like give an important, just kind of show this just for your, so you can, you know, put this on the bookshelf somewhere, remember it for a later date. We see this number at 5:32 a.m. Keep in mind, and however long from now, a month from now, when the revisions come out, this number is going to be revised. And what's funny about this is the market doesn't care about the revision. It only cares about what's printed the first day. So we see the first day is 33%. Market rallies if that's why it rallied. I'll let you be the judge. We're going to go into the charts here and decide for ourselves. But the point is that this is why I don't really like watching news, because for one, the market takes a while for it to react, or it doesn't react at all, or you'll get the revised numbers that come out in a month and the market doesn't care. So that is something that's very interesting. I've always thought it was really interesting in the marketplaces, why it is that the market doesn't care after the fact. Anyway, let's go into the intraday time frame. I'm going to go down to the 5-minute chart just so I can show you what I was really talking about. And as you can see, I already have it on the screen for you. That's at 5:32 a.m. I just want to zoom in like this. I'll get it really on the screen here. And I'll kind of let you be the judge of this. Like, maybe the market reacted, maybe it didn't. We did see this, the market was selling off in the overnight session. Some sort of buyer started showing up here. This almost looked like a bearish consolidation, but it broke out of that bearish consolidation. And then the following candle, we saw maybe leading into the GDP, we did see the numbers come out 5:32 a.m. So this is something to really be mindful of. And then the market traded sideways, and then it looked like it was going to sell off. And all it did is it went down to 325 area, and I don't know the actual price. It's around 325. There is support around 325, and that's why I lean into that price area. I don't necessarily lean into the GDP, and I don't think that was a reason why the market did what it did. However, you may see in the news that's why the market did what it did. So I'll let you be the judge of that. I'll let you decide for yourself whether you think these numbers, something the market has really rallied on or sold off on in the past. Sometimes the market doesn't care. So the market is always ever changing, as we know. So sometimes it doesn't really matter, but then sometimes it does. So remember that for the next time you want to try to trade GDP numbers or trade some sort of news event, remember, sometimes the market doesn't care, and it's going to do what it's going to do anyway. I have to say, leading into the end of the day, I told the traders of the group, be very careful taking or buying into puts right now. This might be a bull trap or it might not be, and we won't know until tomorrow. So far, it looks like the market is trading at 328.85. So we're a little bit less than $1 to the southern side. Not very far down compared to the kind of move that we had today. It's not selling off hardcore in the overnight session, but it is nonetheless down overnight in the after-hour session. So getting into the close of the day, this is not necessarily the most bullish close of the day, and I have to actually, as you can see, some of this price action on your screen right now is after hours, and what we're going to do is we are going to back out of this and go back to the daily time frame. And I just wanted to show you in the morning what I do is overnight, sure, I'm watching it, but then when I go to the daily, I want to turn off overnight because I don't want to see the overnight session. Okay, so now I'm going to go to, oh, did I totally mess it up? Okay. Okay, right now overnight is turned off. What I wanted to see today is I wanted to see price go into this gap from yesterday. I wanted to see it go into the gap or it was prior yesterday, and I wanted to see it close the day up there. It did not close the day. It sold off back below. Something to also note is that sometimes the market during intraday, so when you're trading the 5-minute chart, the hourly chart, it'll look like it wants to close up in that gap, and then this is resistance. So even though it trades up there during the day, you can still kind of take trades off that price. The problem is you don't know necessarily where it is that you're wrong in the trade. So it's very risky, in my opinion, to take a trade. And then normally what you would do is you would set a stop loss at this price area, but it depends on what chart you're trading. So if you're trading the daily chart, the price can go all the way up into this gap. And then as long as it closes the day back below the gap, you're still good on the short trade as far as day trading goes. Now, if you're intraday trading, or let's say you're let's say you're not doing, or I'm sorry, that was for swing trades. Let's say you are doing day trades. That's where you have to be careful, because it can, like I said, it can come up into this gap. And let's say it starts closing 5-minute candles, 10-minute candles up in the gap. At a certain point, you're going to have to stop out of the trade. Now, for me, I'm a swing trader. So what I'm looking for is I'm looking for the daily close or hourly closes or 2-hour closes, something bigger than a 30-minute candle. I want to see more conviction from either the bulls or the bears, and that will lead me to discern what I want to do with my trade. Now, off of that, we're going to go back to the daily and really dive down here. I've had a couple people reach out to me and they asked me, where do you see the market going from here? Because I was kind of bullish. You know, I've been doing a lot of bullish posts. I've been doing a lot of bullish alerts. And so what we do see is we see this run up to all-time highs, 358.75, and we see a pullback, and then it rallied, tried it again. And let's do something different here, because it's really hard to see that. Let's do that. So again, you see this run up, it pulls back, it tries to run up again. It does not break over this not only the all-time high, but doesn't break over this rejection candle, this reversal candle on the daily chart. And so then since then we've sold back off. And like I was saying, the last couple days does look the last couple days being today and yesterday alone look more bearish, and I have to give the bearish case to the bears. And yes, the longer term trend is up, and that's also something that we have to keep in mind. We have higher highs and higher lows up in this area. It goes higher highs and higher lows, all-time high, pulls back, and then it rallies again, pulls back. Now what we are looking for me to be a short trader, for one, I want to see us get back underneath this 200 period moving average. Sure, I'll take small short trade, swing type trades, but the big short trade that I'm looking for is if price got below this area, below 319 and below this 200 day moving average. That's what I'm looking for. And what let's clear the air right now. I'm going to zoom in on this a little bit more, blow it up a little bit. Let me clear the air a little bit. What I'm looking for is a convincing red candle below this price level. And you also have trend lines that come up like this. I think there's even one that comes up something like this that was already broken. So what I want to see, will I be chasing the price down to the downside? So let's say tomorrow morning I see the market open around 325 and it immediately starts selling off below this area. Am I going to chase a 1-minute candle or a 5-minute candle or a 15-minute candle down here? No, I will not chase a 15-minute candle down to the downside. What I'm looking for is it to sell through that level, for it to pull back test possibly. And the back test doesn't have to be actual back test of that price. It could be, let's call this whole area zone. I'm looking for a back test, and then I'm looking for it to sell off again. And then as soon as it takes out that low, the first low that it puts in after it does the initial break, now that I have 500 lines on the chart, you kind of get the picture, right? We're not in it to chase price. We don't want to chase price. If we find ourselves chasing price, we're going to lose money. We're going to lose the trades. Now, one other thing before we get off of the SPY, there's one last aspect that I want to look at, and that is this. I was saying before, we had this channel in here before, and the channel went to somewhere around here. We're going to now make that channel a little bit wider because there's something that I did notice. Let me activate this really quick. And this is where we have to be very careful drawing channels or drawing trend lines. The problem is that, let's say I'm bullish, excuse me. Let's say I'm bullish the market. My trend lines and channels and everything, every time I have a daily candle that closes, let's say tomorrow's candle closes right there. Next thing you know, I'm going to come in here and I'm going to try to draw some uptrend line from another point, right? Or I'm going to try to draw some support over here coming across the screen from another point. I mean, at a certain point, it becomes a little bit ridiculous on the kinds of lines that we can draw on the chart to meet our needs. We have to be mindful of that. However, being a bull, I want to be mindful of, what do all the bears see? Well, I can tell you right now that a lot of bears are eyeing this level. Like we were saying, it's a zone. And they're also eyeing this 200 period moving average. Now, I don't think that the 200 period moving average holds... I don't think that it holds as much weight as horizontal price support or some sort of sideways trend lines. I don't think it holds as much support, but it's something to be a little bit cautious of. Let's get off this chart. This is just something I noticed, and I don't mean for this pattern overall to be bullish or bearish. It's just another trend that I noticed. Now, there's two areas. Well, actually, before we get off this chart, one piece of other technical analysis thing, or it's more of a trading managing trades scenario. There's two ways to trade, right? Well, there might be more. feel free to leave a comment under the comment section of the video and let me know what you think about this. There's two ways to trade, in my opinion, right? You have price levels, right? And so this one is 325. Let's say that this is the support, and today we decided to step in and be buyers because, after all, the market is making higher highs, higher lows. It pulled back. I'm going to be a buyer at this level. So there's two ways to do this. One is you can buy support and put a stop loss just underneath support. The other way to do it, in the more probable way and the best risk to reward setup possible, and there may be people who disagree with this, and that's okay. I want you to leave a comment under the video. This distance from here to here is pretty far away, right? And so let's say hypothetically price did get up to this level, and let's say it broke through that level. Do I want to be chasing price? No, because of where it just came from. Look where it just came from. However, this is the best trade risk versus reward setup. The highest probability trade setup is waiting for the breakout. But again, that's quite a ways away. So, like I was saying, if you see a couple consolidation candles in here over the next couple days, then we could draw a trend line down here and possibly attack this breakout if it comes. Now, one last thing, and then we'll get off this chart. Let's go to SPX because there's something else I wanted to show you, and I might have already deleted it. Let's see if I didn't delete it. I hope I didn't delete it. I did. I deleted it. Oh, no, I didn't. Okay, so here's something I wanted to show you guys. Do I think the market's going to roll over? This is from 1990. This is from 1991 down here. As I come up through here, you see I'm sorry, not 1991, 1931, 1939. Here's the 1940s. Here's the 1950s. Okay. Into the 1960s, just follow my cursor. 1970s. 80s, and then as we get into the 90s, you see this presidential election, and it ran 334%. Okay, then we came into the next presidential election, right, which was Bush. It ran sideways to down. I think it was down 30% over the course of 4 years. The next thing you see is oh, that might have been Clinton. That possibly was Clinton. I might have given you some false information there. No. That was right. Okay, so the next election you see Obama, right, which was in 08. You see Obama, and it ran up from where he was at. It ran up 131%. The next election is the Trump presidency, and you see this has run up 55%. So something to consider here, and something to really think about, especially for our long-term trades. And now you can kind of really see it on the screen here if I do this. And I know this video is getting a little bit long in the tooth, but I really wanted to dive in here and show you. The reason why this election back here it was the Bush election, was the date was a little bit off, was because it took a Supreme Court. There was a voting issue in Florida, and so we won't get into that. But that's why the date is a little bit off. But once the market found out about it, this is when it kind of reacted to that. And that's why that's not why the market was down, but there was uncertainty around that time period. And so over the next 8 years, it was pretty brutal of a time period in the markets and out of the markets. And then, of course, so this is the point I want to get to. My point that I want to get to is, no matter what you do, if you have a long-term account, I don't see any reason to sell. I don't. In fact, history shows us that the market steadily goes up. Now, there are times that you're going to have to endure the pain. Are we coming into a time right now where we endure the pain? It is absolutely possible that we are coming into a time that we are going to have to endure the pain. But with that said, I keep seeing people post things about bear markets, and we're going in for another bear market. I'm kind of curious to what it is everyone has a thought on this, and then again, leave a comment underneath the video. People were way more bearish right now than they were back here, right? People are way more bearish. I don't know. I don't necessarily know why. I think it's because we are expecting a massacre sell-off, right? And right now I'm looking at the after hours is 327.74. So the market is still selling off a little bit. But what traders are and investors are, as we're coming into the election, there's more uncertainty. Maybe that's why. Maybe people are more bearish now than they were back here. When in fact, back here, we were down 10.5% or 10.69%, right? In this pullback, we're down 8%, 8.18%. We're not even down as much. However, from the market all-time high till today, we're down 9.38%. We aren't even in correction territory yet. We're getting close, but we're not there yet. For me to be a believer in a bear market, like I said, it would have to be a lot lower. In a bear market, we would be looking at prices down here. For it to be technically called a bear market, we'd be looking at prices around 286. Do we really believe in the next 6 months that prices could be that low? I don't know. Maybe they will be. And as I say that, I notice this gap over here. It'd be amazing if that gap got filled way back here. Do I think March lows? Because this is where traders kind of reached out to me and asked me what my opinion was. Do I think March lows? I don't think so. I really don't. I don't think March lows. I think the coronavirus was, we were in a bubble, right? We were in a bubble. You had the repo market going on. There was a liquidity issue. There were rates issues. And when the coronavirus came, or the pandemic came, it turned into a massive fear, which sold the market off. But the market was already having issues, right? So it sold off dramatically. In my opinion, it's, what did market sell off? 35%. That's pretty dramatic in such a short time period. Now, with that said, is it possible that we go down to the March lows again and we go back and look at that megaphone pattern? Absolutely. Here's the megaphone. Is this possible? It's in the realm of possibilities, right? This is absolutely in the realm of possibilities. All I have to say, though, is as far as being a long-term holder, even if this took 2 years to get down that low, which I think that the next bear market would be I think it'll be a long, painful thing. I don't think it's going to be a crash. I think it'll be a rolling over like it's doing right now, right? I think it's starting to roll over. That would be more probable. But even if we did get down there, it'll be a pretty quick recovery, or maybe it'll take another 2 years to come back up. Within 5 to 10 years, we're going to be above the prices we're at now, right? That's another way of looking at it. Historically, that's what the charts are showing us. Now, let me get off of all of that because this is getting really long. Let's just go to the Qs. And again, we're looking for a market to roll over. If it's going to roll over, I don't think it's going to happen. I think it's going to rally the way it is. It pulls back. We're going to lose the straight lines, right? The rollover is going to do this. Up, down, up, down, up, down. And then there will be days. And let me do something for you guys. Does that blind you? You guys, you can't even see it on the chart. Yeah, I don't think you can see it on your screen. What if I do this? Nope. Well, I learned something new today. Okay. Anyway, what I was trying to draw was this. You're going to lose these straight lines, right? It's going to start doing this. It might look straight, but over time it'll start to roll, and then one day it'll snap, right? That's what in my opinion, that's what it's going to look like. It's not going to be like the pandemic where it just sells straight down into the abyss, So many possibilities. There are many things possible. There are a lot of possibilities, right? Qs, same thing, bearish on the daily chart. You have a break of trend, right? And if we wanted to call this a trend, since we stopped calling it a bull flag, if we wanted to say this is some sort of trend, it broke down through that and we went back up to back test it. And in fact, it probably faked out some of the bulls because some of the people were buying this back up into this channel up here, or this bull flag, thinking that we're back up in the channel. The problem is we didn't close the day back up in the channel. We're actually back below the channel. So it's more probable, in my opinion, that the Qs start to roll over. However, with that said, maybe the earnings and maybe things that come out, maybe the market will adjust tomorrow and we'll keep rallying from here. I would have liked to seen lower prices in the Qs, and I had this 266.90. I don't even know when I put this on the chart, but this looks like pretty decent support from back here, and you can see it goes all the way back to July. You can see the price ran up into it, and anyway, you get the picture. There's support and resistance through this area, so 267, let's call it. IWM. Same thing with the IWM. You had a fell off. Right? It broke trend, it broke support, and we had a back test today. Now the question is going to be, okay, tomorrow, is the price going to open up down here around the 200 period moving average? I would like to see the prices a lot lower. And not that I want to see them a lot lower. What I mean is, if I want to be a buyer, I want to get a deal. To me, this isn't that much of a deal. And this isn't as big of a deal as I thought it would be, especially the way that the chart looks. The chart does not look healthy. Even today's price action, yes, it was an engulfing candle, but if you looked at this and said, you know what, if we went and looked at the futures right now, it looks like this is a giant. Let me do this. Let me get a red candle here to show you what it would look like. There's the candle. Does that change the picture for you? Right? There's the red candle. And let's go to the green candle. Here's the green candle. Bullish or bearish? Right? So whenever you see gaps like that, that's what really you have to take into account. There's a big candle here. That's a big candle. That's a reversal candle. That's a downtrending candle. The chart is rolling over. Lower prices, in my opinion, are more probable than higher prices. It's just a matter of at what price level are you willing to short it again. You know, we want to wait for the rallies, right? XLF, same thing. If I zoom in on this chart, and this, you know, said I took a long trade in XLF today. So just looking at this again, you look at this chart and then you have to say, well, there's a red candle here. Okay. Pretend like that's one red candle because it is. And then here's your green candle. Now today's candle was almost like a reversal candle based on this volume that we see down here, plus the type of wick that was off the bottom. That could be, and it closed this gap, so it looks like pretty solid support. But just looking at the candles themselves and not looking at the volume or the gaps or anything else, ask yourself that question: is this price action bullish or bearish? Right? Something to be mindful of. And let's finish it up with the SPY and double dip on the SPY, and then we'll get off of the charts here, and I'll let you guys go for the day. So same thing with the SPY. I'm going to do this. And first of all, something I noticed here is I don't think this candle yesterday, this wick you see in the candle yesterday, this is actually a gap, and price was, let me see here. I don't want to give you false sense of hope. Okay, so, and now you can see this downtrending channel again, but so as high as the price got yesterday was 332 roughly. Let's go back to the daily chart. And I can tell you right now that candle, this wick, upper wick right here, is not really here because the price never actually got up there. However, again, let's do the same thing. Let's go do this. Let's draw it in. Here's your candle. Okay. And then let's put in the green one. Here's the green one. The difference with the green one is the sellers push the wick down to this level right here, making it one of these, right? Is that more bullish or bearish? Is this an inside day, right? Is this a consolidation day? Even though intraday, it felt like a monster rally. And I even told the traders in the group, be very careful shorting this. Be very careful shorting the highs up here, because they're going to make it look like they're going to sell it off into the abyss. And what they're really doing is whipping you out of the trade. And then in the middle of the night, when none of us are looking, we're going to wake up and it'll be a gap higher in the morning, and we're going to be sitting up here halfway up the gap again. So be very careful taking these kinds of trades. Be very careful with options because they're extremely risky, right? We want the best trade setups possible. Do we want to take a trade when price is sitting just underneath of a gap? Regardless of the context that the chart is in, and let me get my cute color up here. Okay, do we want to take a trade just underneath this price area, right? Is this a pullback? And then price is we're gonna wake up to a gap higher in the morning. In my opinion, the reason why I believe that this can be possible is because the market likes to get as many, the market likes to make as much money as possible on all the retail traders. And what I noticed today is there's a high number of retail traders who are shorting this price action. So they can be right, and we can wake up to a gap down in the morning. And if we do wake up to a gap down in the morning, well done, retail traders, for getting over on the institutions. You know what I mean? So it's one of those scenarios where who's going to be right? Okay. Okay, that wraps up for the video. Again, if you agree, if you have your own opinion on it, put it in the comment section underneath the video. And Be sure and hit the like button if you've gained value out of the video. Hit the subscribe button. We go live every Sunday, 5 p.m. Pacific Standard Time. And thank you for spending these last, I don't see the clock, 40, 30 minutes with me. Appreciate it.